Your bank is not keeping your money safe. It is using your money to make money. Right now, while you are watching this, your savings account balance is being lent to someone else at an interest rate significantly higher than what your bank pays you. The bank manager did not call to ask permission. There was no form to sign. This is simply how banks work, and almost nobody explains it clearly. And there is one item on this list that your bank makes more money from than any other source. It requires zero effort. It costs them nothing. And the reason it works is entirely because of something you do, or, more accurately, don't do. We will get to that one. But first, 7 other ways your bank has been running a very profitable business. Using your money, let's get right into it. Number 8. Net interest margin. Meet Arjun. Arjun is 24. He got his first HDFC salary account last month without being asked. He transferred 40,000 rupees to his SBI savings account because his mother said government bank is safest. SBI is paying Arjun 3.5% interest on that money. Meanwhile, SBI took Arjun's 40,000 rupees and lent it to someone buying a house at 9% interest. SBI pays Arjun 1,400 rupees a year. SBI makes 3,600 rupees a year from Arjun's money. The gap between those two numbers is called net interest margin. Every single bank in India runs on this gap. The bigger the difference between what they pay you and what they charge borrowers, the more profitable the bank. Arjun thought he was the customer. Arjun is the raw material. Number 7. Processing fees. Imagine Priya applying for a personal loan at ICICI. ICICI charges her a processing fee, roughly 1 to 2% of the loan amount, before she gets a single rupee. The loan has not been given yet, the risk has not been taken yet. The work involved is approximately 20 minutes of someone checking documents. The fee has no relationship to the actual cost of providing the service. It exists because Priya needs the money, and ICICI knows she needs the money. Processing fees, prepayment penalties, NEFT, charges beyond the free limit, check bounce fees, SMS alert charges. Each one looks small individually. Collectively, they add thousands of crores to Indian bank revenues every year. You notice each charge for about 30 seconds. The bank does not notice it. The bank designed it. Number 6. Minimum balance penalties. Every Indian has been here at least once. You check your SBI account. You are 200 rupees short of the minimum balance requirement. SBI has charged you 500 rupees as a penalty. You did not spend 500 rupees. You did not make a transaction. You simply had slightly less money than the bank required. The penalty for having less money is more money taken from you. SBI collected 1,771 crore rupees in minimum balance penalties in a single year, mostly from account holders in smaller towns and villages, people with the least money paying the most penalties. The bank did not design this to be cruel. It designed this to be profitable. The cruelty was a structural coincidence that nobody at the top floor felt the need to correct. Number 5. Credit card interchange. Every time you tap your credit card at a merchant, that merchant pays your bank 1.5 to 2% of the transaction value. You pay nothing. The cashback you receive is funded entirely from this fee. You feel like you are winning. Here is what is actually happening. The merchant, your local restaurant, your kirana store, your favorite clothing shop, builds that 1.5 to 2% cost into their prices. You pay it anyway, just indirectly. The bank collects from the merchant. The merchant collects from you. The bank issued the card. The bank runs the payment network. The bank wins from both ends of the same transaction. Your cashback is the bank returning a fraction of what it already took from you through a system you didn't know existed. Number 4. Float money. Every business in India has a current account. Current accounts pay zero interest. A restaurant chain, a growing startup, a manufacturing company, all of them keep crores sitting in current accounts, earning absolutely nothing. The bank takes that money, lends it out immediately, earns interest, pays the business zero. The business doesn't complain because current accounts come with faster transactions, overdraft access, and relationship managers who take you to lunch. But the core arrangement is this. Your business gives the bank free money to use. The bank keeps everything it earns from the free money. HDFC has current account deposits running into tens of thousands of crores, all of it earning the bank interest, none of it earning the depositor a single rupee. The lunch was not free. You paid for it in a currency you didn't know you were spending. Number 3, Forex Margins. Imagine Arjun goes to Bangkok for a week. He uses his HDFC debit card for everything: hotels, food, tuk-tuks, the obligatory elephant sanctuary. HDFC charges him a 3.5% foreign currency markup on every transaction. The exchange rate he checked on Google before leaving is not the exchange rate he actually gets. He gets a worse one. The difference goes to the bank. On a 1 lakh rupee trip, that is 3,500 rupees quietly deducted before he buys a single meal. The airport Forex counter is worse. The margin there runs 7 to 10%. Every student going abroad, every family on an international holiday, every company doing cross-border business, all paying a silent tax on every transaction. The rate you see and the rate you get are never the same number. The gap between them is a product the bank sells to you without describing it as a product. Number 2, insurance cross-selling. Your bank relationship manager called last month. They were warm, they were helpful. They had a special product just for you. An LIC endowment policy with guaranteed returns, tax benefits, and life cover all in one package. They recommended it personally. Here is what they did not mention. Your bank earns a commission of 30 to 40% on the first year's premium every time a customer buys that policy. Your relationship manager has a monthly sales target. Their annual appraisal depends on how many insurance policies they sell. The recommendation felt personal. The conflict of interest was institutional. The policy returns 4 to 5% over 20 years. A simple index fund returns 12 to 14%. The bank did not sell you a financial product. It sold you a commission in a policy-shaped box. The relationship manager's relationship is with their sales target. Your financial future was what they were selling it with. Number 1, your ignorance. Everything on this list made the bank money. This one makes them the most. And the reason it works has nothing to do with the bank and everything to do with you. Not stupidity, not carelessness. The kind of ignorance that is completely rational, given that nobody explained any of this to you. You have never read your savings account terms and conditions. You have never compared interest rates across banks. You have never switched to a better account even when one existed. You have never questioned why the relationship manager recommends the same 3 products to everyone. You set up autopay, checked your balance occasionally, and assumed the bank was fundamentally on your side. The bank knows this. It has always known this. The entire retail banking model in India is built on one assumption: that you will not check, will not compare, and will not switch. That assumption has been correct at scale every single year without exception. The bank does not need to do anything to maintain it. You maintain it for them. This video is the most expensive thing your bank wishes you had never watched. That's all for today. I'll be making similar videos in the future. Subscribe to see them.